Hello, welcome friends. Once again we are with a new topic to be discussed today. That is the concept of excess demand and deficient demand. Now you must remember that in this topic we will be discussing the meaning of the term excess demand and deficient demand. Now, what is the impact of excess demand and deficient demand, and how excess demand and deficient demand in an economy can be controlled with the help of instruments of fiscal and monetary policy. So, I hope this chapter will be very useful for preparing in the board's examinations, especially for the students of class 12 and also the students who are pursuing graduation with economics as a paper. So today we are going to discuss the concept of excess demand. Now before discussing the concept of excess demand, we will discuss the concept of full employment. Now, what is full employment? Full employment refers to an economic situation where the resources which are at the disposal of a nation are optimally or fully utilized. That means the people who are willing to work at the prevailing wage rate are finding job or getting jobs. That is called as full employment. But remember one thing, that full employment does not necessarily mean that all are employed, because there may be some people who may not be willing to work, that is they are voluntarily unemployed. Voluntary unemployment means that when the people are not willing to work at the existing wage rate because of their personal reasons. For example, the idle poor. Okay, so in that case what we find? That he may be willing to go for begging instead of going for a job. And similarly, idle rich. There are some rich people who may be willingly unemployed, though they are finding jobs at the existing wage rate. So that is called as voluntary unemployment. Now you must remember that these people like to remain idle and are reluctant to get employed themselves at the existing wage rate. As I have said, that idle poor or idle rich, they are included in this category. Now remember that there is also another aspect, that is frictional unemployment. Now frictional unemployment arises in an economy when there is some technological changes, or when there is fall in demand for the industrial goods, or when the people are willing to switch off to some other jobs. So during this span, they remain idle. So this frictional unemployment in case of developed countries has been seen about 3 to 4%, which cannot be treated as unemployment. So though there exists frictional unemployment in the economy, it will be considered as full employment. Now, remember that what is excess demand? Excess demand means what? When the present level of aggregate demand exceeds the aggregate demand which is required to attain full employment, is called excess demand. And excess demand, in other words, can be said to be a situation where aggregate demand exceeds aggregate supply at the level of full employment. That means the community is spending more on consumption without any corresponding increase in the level of output or employment in the economy. So it has an inflationary impact on the economy. Now, what is actually inflationary gap? Inflationary gap is the gap which is created when the present level of aggregate demand exceeds the aggregate demand which is required to attain full employment. That gap is called as inflationary gap. Now this can be explained with the help of given diagram. In a given diagram, you find that this is your aggregate supply curve. Aggregate supply, we have said or we have discussed in our earlier class that it represents the aggregate output of the economy, and AS is always equal to Y, that is aggregate income. And suppose this is your aggregate demand curve. Aggregate demand curve represents what? The aggregate expenditure which the community is expected to incur on the purchases of goods and services that are produced in an economy during the year. Now, this aggregate demand curve has intersected the aggregate supply curve at point E. And at this point, the equilibrium level of national income is OY. Now suppose we assume this as full employment equilibrium. Full employment equilibrium. Now, at the level of full employment, if aggregate demand exceeds aggregate supply, by AD1 amount, the gap which is created between the present level of aggregate demand and the aggregate demand which is required to attain full employment, represented by AE, represents your inflationary gap. Now dear friends, what I have said, just let me recapitulate. Let me recapitulate that here, where the present level of aggregate demand exceeds aggregate demand which is required to attain full employment, represents excess demand, and the gap which is created, represented by AE at full employment level of income OY, represents inflationary gap. So here you are showing AD and AS, and here you are showing national income. Now the question arises that how this can be controlled, or why it actually arises. Remember, first of all we will be discussing that why it actually arises, that is causes of excess demand. What are the causes of excess demand? When the community, that is households, are spending more on consumption, that results in excess demand. When the producers are making more investment expenditure, that results in excess demand. Or when the government increases its spending on public utilities, that results in excess demand. Now we are discussing how bank rate policy is used to correct excess demand in the economy. Now before that, you must know what is bank rate. Bank rate is the rate at which the central bank of a country lends money to the commercial banks. So when there is excess demand in the economy, the central bank increases the bank rate, and as a result commercial banks reduces, and that makes credit costlier. So naturally, what is its impact? The households will reduce their demand for borrowings for consumption purposes, and the producers will be discouraged to take new investments. So, as a result, the level of excess aggregate demand in the economy will reduce, and that will help to correct excess demand in the economy. So, what is the essence? That when there is excess demand in the economy, the central bank increases the bank rate. This reduces the availability of the credit with the commercial banks. Consequently, this makes credit costlier and thereby discourages both consumers as well as the investors to demand loans for consumption and investment purposes in the economy, and thereby it helps to correct excess demand in the economy. Now, number 2, we are coming to cash reserve ratio. Now, what is cash reserve ratio? Cash reserve ratio is the percentage of total demand deposit liabilities of the commercial bank, which the commercial banks have to keep as cash reserve with the central bank. Now, suppose the commercial bank receives a deposit of rupees 1 lakh, and we assume that 10% of this total demand deposits has to be kept by the commercial bank as cash reserve with the central bank. That means rupees 10,000. So 90,000 rupees is available with the commercial bank to lend for lending purposes, which will be available in the market for borrowing purposes. Now, suppose this 10% is increased from 10. This percentage is increased from 10% to 20%. So, what will be the availability of the credit with the commercial bank? 80,000 rupees. So, naturally, it has to increase the rate at which it lends money to the public for consumption and investment purposes. So, this will discourage borrowings for consumption and investment purposes in the economy, and thereby help to correct excess demand in the economy. Thirdly, we are coming to open market operation. Open market operation refers to the purchase and sale of government securities and other securities by the central bank to the commercial bank. Now, when there is inflation or excess demand in the economy, the central bank sells all its government securities to the commercial banks. Now, as a result, the credit availability with the commercial banks reduces. So, when there is decrease in credit availability of with the commercial banks, this makes credits costlier, and as a result, it discourages borrowings for consumption and investment purposes in the economy. Consequently, it reduces the aggregate expenditure in the economy and thereby helps to correct excess demand in the economy. Next comes that in times of excess demand, the government may increase its exports. So when there is increase in exports, what will be the exports? Imports, imports. So now the other measures include increase in imports. Now in times of excess demand, the country can increase its imports to meet the consumption demand in the domestic economy, and doing so will help the economy to correct the problem of excess demand. And lastly, we can say that it can increase its output. Now aggregate demand can also be excess demand can also be controlled by increase in volume of production in the domestic economy. But in the short run, this may not be so effective as compared to the long run, because in the short run, when the economy is already operating at full employment level, the possibility of increase in production is not possible. So therefore, it is possible only in the long run when there is possibility of increase in supply of resources in the economy. Now, this was the concept of excess demand. So now we are discussing the causes of excess demand in an economy. So let us first again have a short recapitulation of the causes of excess demand. Number one, which we have discussed, is that increase in consumption expenditure by households results in an increase in aggregate expenditure in the economy, or it leads to excess demand in the economy. Secondly, when the investment expenditure in the economy increases, that also results in increase in aggregate demand. Thirdly, what we find, that when the government spending not matched by increase in taxation by the government also results in excess demand. Besides, when there is increase in exports, the domestic output is domestic demand, the output of the economy is not matched with the aggregate demand in the economy. So that also results in excess demand. So now the question arises that how excess demand can be corrected. Now you must remember that the government of a country may use different measures like fiscal policy or the monetary policy and other measures to control excess demand. Now let us first discuss that what is fiscal policy and how and what instruments of fiscal policy are usually used to check excess demand in the economy. Now, fiscal policy is the policy of the government of a country, whereby or wherein it uses the instruments of taxation, public expenditure and public borrowings to attain the economic objectives of the economy. Or you can say that fiscal policy is the policy of the government of the country wherein it uses or wherein it regulates its budgeted revenue, which comprises of taxation, non-tax sources of revenue. Taxation may be in the form of direct and indirect taxes. Direct taxes includes income tax, corporate gain tax, also called as corporate profit taxes. And whereas indirect taxes includes GST, goods and services tax, customs duties, excise duties as applicable in case of India. Now, on the other hand, non-tax revenues include the sheet. Then it may also include the surplus of public sector and donations received by the government. So it manages or regulates its budgeted revenue and budgeted expenditure. Budgeted expenditure here represents the government spendings on various economic activities. So by managing this tool, the government tries to bring about desirable effect and reduce undesirable effect on the level of output, employment and income in the economy, and thereby check the price levels in the economy. Now see, in today's day, the economy is facing inflation. Rather, the entire world is facing the problem of inflation due to the rising price of crude oil, gas, etc. And hindrance in the or the breakdown in the supply chain. So that has resulted in spurt in price levels that are prevailing in the economy, and that has adversely affected the social life of the people, or you can say the standard of living of the people of different countries, and India not being an exception to it. So under this situation, if the country wants to control inflation, or you can say excess demand, it can use fiscal policy as a measure to control the same. There are generally three measures that are taken under fiscal policy. Number one, the taxation policy. Now, in order to reduce excess demand or check inflation, the government may increase the existing rates of taxes, say income tax. This will income tax, and also levy new taxes. Levy means impose new taxes on individuals. And naturally, what will be its effect? It will reduce the disposable income of the households, and that will help reduce excess demand in the economy, and thereby help control rise in price levels. Number two, the government will reduce its public spending, specifically on the non-developmental expenditures or unproductive expenditures, like the expenditure on maintenance of defense. Secondly, the expenditure on administrative activities. So these all things will be reduced, and that will help to reduce the level of aggregate demand and thereby the price levels. And thirdly, the government will go for large scale public borrowings. As a result, the surplus or idle funds lying with the individual or public will go to the government, and that will help to control excess demand in the economy. Now, on the other hand, monetary policy can also be used as an effective measure to control excess demand in the economy. Now, let us first know what is monetary policy. Monetary policy is the policy of the central bank of a country, whereby it regulates the supply of money and credit in the country to produce desirable effects and reduce undesirable effects on the level of employment, output and income in the economy. Now, the various instruments of monetary policy are bank rate policy, open market operation, cash reserve ratio, margin requirement, then moral persuasion, credit rationing, all are the measures that can be used by the central bank to check inflation or excess demand in the economy. So first of all, we are coming to cash reserve ratio. Now, how cash reserve ratio is used to check excess demand? Before that, you must know what is cash reserve ratio. Cash reserve ratio is the rate at which the central bank of a country lends money to the commercial banks. Now remember, when this cash reserve ratio is raised by the central bank, the credit availability with the commercial banks. Now we are coming to the concept of deficient demand. Now what is deficient demand? When the present level of aggregate demand falls short of the aggregate demand which is required to attain full employment, represents deficient demand. That means you must understand here that when aggregate demand in the economy exceeds aggregate supply which is required to attain full employment in the economy, represents deficient demand. So we can say here that when there is deficient demand in the economy, there exists involuntary unemployment. Now, what is actually involuntary unemployment? When the people are willing to work at the prevailing wage rate but are not finding jobs, it is called involuntary unemployment. You have seen during the situation of pandemic that there was lockdown all across the country, rather all across the world. And what was its economic consequence? That people were thrown out of employment. So that means the people were willing to work at the prevailing wage rate, but they were not finding jobs. So that situation represents involuntary unemployment. Now, naturally, when there is involuntary unemployment in the economy, it has a deflationary impact in the economy. Deflation refers to a situation where the general price levels continues to fall, and as a result the general price levels continues to fall, and as a result what we find that there is wide unemployment in the economy, because the producers are reluctant to undertake new investments out of the apprehension that they will not find market for their produce, because there is already huge stocks lying unsold with the producers. In India, we had seen that it had severely affected the transport sector, and there was a recessionary impact. And recession is like a virus, because it encroaches all the sectors of the economy into its trap, leading to depression in the economy. Now, the question arises that what are the causes of deficient demand? When the consumption expenditure in the economy falls due to the fall in the disposable income of the households, that results in deficient demand. Number two, when the investment expenditure in the economy reduces. Number three, when the government spending reduces, or when the money supply is reduced in the economy, that results in deficient demand. Now, the question arises that how to correct deficient demand. So under this situation, the country can adopt either fiscal measures or monetary measures or other measures to control the adverse effects of deficient demand in the economy. Now, first of all, we will take up with fiscal policy. As I have discussed earlier, that fiscal policy is the policy of the government of a country, whereby it uses the instruments of taxation, public expenditure and public borrowings to attain the economic objectives of our country. Now, when there is deficient demand, the country must seek to raise the level of aggregate demand in the economy. Why? Because the very purpose is to create demand in the economy so that the producers get confidence in the economy and take initiative for new investments, and that will help to increase the level of output, employment, income in the economy and the price levels, and that will bring about a boost in the economy. That means it will foster economic growth. Now see, you have observed that in the post-pandemic period, the measures that were taken by the government of India to overcome the challenges that was faced by the economy during the pandemic period, the government used both its fiscal and monetary policies to create demand in the economy and create an atmosphere for new investments. For that, the government adopted the policy of Make in India and Made in India concept, and it created opportunities for startup business so that employment is generated in the economy. So, from here I can say that the fiscal measures that are taken by the government to correct deficient demand in the economy are: number one, decrease in taxes by the government. That means the government will reduce the existing rates of taxes and waive certain taxes so that the disposable income of the households increases, which will induce them to spend more on consumption, and that will help to increase the level of aggregate demand in the economy and thereby will help to solve the problem of deficient demand in the economy. Number two, public expenditure. That means the government, in order to create demand in the economy, will increase public spending. That means it will provide employment opportunities for the people, provide old age pension, unemployment allowances. It will increase both developmental and non-developmental expenditures in the economy. That will help to create demand in the economy. Because during this situation, what we find that when government spending increases, the disposable income of the household increases. When the disposable income increases, they spend more on consumption. So when the level of consumption in the economy increases, it induces the producers to invest more, and as a result the level of output, employment, income and thereby prices start rising, and thereby that fosters economic growth. You must be knowing that as per the statistics on current date, the present rate of growth in GDP in India is 13.5%, and that is the highest as compared to other developed countries in the world. And it is expected that in the coming years, India will be one of the fastest growing economies in the world. Now, number three, the government will not go for public borrowings. That means it will repay its public debts. So when public debts are repaid, what will be the effect? The money flow in the economy will increase, and that will increase the disposable income of the households, and thereby they will spend more on consumption, and as a result the level of aggregate demand will increase, and that will help to correct the problem of deficient demand. Now, on the other hand, the central bank of a country can pursue or adopt monetary policy to combat the problem of deficient demand. So, the instruments of monetary policy that are being used to control deficient demand are bank rate policy, open market operation, cash reserve ratio. As I have earlier said, that bank rate is the rate at which the central bank lends money to the commercial banks. So when there is deficient demand, the bank rate is reduced. So when bank rate is reduced, the availability of credit with the commercial banks will increase. This will make credit cheaper and thereby induce both the consumers as well as the producers to go for more borrowings in order to meet their consumption and investment expenditure, and therefore that will help to boost aggregate demand and thereby help to correct the problem of deficient demand. Number 2, open market operation. What I have said earlier, in times of excess demand, what we find that the government has to see, the central bank has to see that how the liquid cash held with public can be squeezed so that aggregate demand can be checked. Now here, just the reverse will be adopted. That means the central bank will buy back all the government securities from the open market. And as a result, the credit availability with the commercial banks will increase. This will make credit cheaper. And as a result, both the consumers and the producers will go for more borrowings. As a result, consumption and investment expenditure in the economy will increase, and that will help to increase the level of aggregate demand and thereby help correct excess demand in the deficient demand in the economy. And thirdly, cash reserve ratio. Now, while discussing excess demand, I have said that cash reserve ratio is the percentage of total demand deposit liabilities that has to be kept as cash reserve by the commercial bank with the central bank. Now here, you must remember that when there is deficient demand, this cash reserve ratio is reduced by the central bank. As a result, what happens? Availability of credit with the commercial banks increases, and when availability of credit with the commercial banks increases, it makes credit cheaper. Consequently, what happens? The demand for borrowings in the economy increases, both for consumption and investment purposes, and that helps the economy to overcome the problem of deficient demand. Now, I was discussing the concept of deficient demand, wherein I discussed the concept of deflation. Now, you must remember that when there is deficient demand in the economy, it creates a situation of deflationary gap. Now, you must remember that what is deflationary gap? Deflationary gap is the gap which is created when the present level of aggregate demand falls short of aggregate demand which is required to attain full employment in the economy. Now, in the given diagram, are assuming in the given diagram, we are assuming that this 45-degree line is the aggregate supply curve. At any point along this curve, aggregate income is always equal to aggregate expenditure, and AS is equal to Y. Now suppose this is the aggregate demand curve. Aggregate demand refers to the total money expenditure which the community is expected to incur on the purchases of goods and services that are produced in an economy during a year. And it starts from the Y and X axis and moves upward to the right. Because in the short run we assume that investment is autonomous. That means it does not change with the change in the level of income. So therefore it is the consumption expenditure which actually brings about increase in aggregate demand. Now point E represents full employment equilibrium, and at this level the full employment level of income is OY. Now suppose at full employment the aggregate demand reduces to 81. Now what we find that when the present level of aggregate demand falls short of aggregate demand which is required to attain full employment in the economy, represents deficient demand, and the gap so created represents deflationary gap represented by AE. So here this represents deflationary gap, and this represents your full employment equilibrium. So what we can conclude, that deflationary gap is the gap which is created when the present level of aggregate demand is less than the aggregate output at the level of full employment, that represents deflationary gap. And we have already discussed the measures that are to be taken to correct deficient demand or deflationary gap in the economy. Now, the questions generally that are asked in the board examination on this topic are that what is deflationary gap, and show it diagrammatically. Number 2, how excess demand can be controlled using fiscal policy. How monetary policy is used to control deficient demand in the economy. Next, that how fiscal and monetary policy is used to control excess or deficient demand in the economy. And what is inflationary gap or what is deflationary gap? These are the probable questions generally asked from this chapter in the board examination. Now here you must remember that as per the new pattern adopted by CBSE and ISC, there may be multiple choice questions as well as short answer type questions and long answer type questions. Thank you so much. Hope you will like this video, and I will request all of you to like, subscribe and share the video with your friends. Hope the best.